Hello everybody, it's Tortoise Investing coming at you today with an explanation of how dividends are taxed. We're going to be going over ordinary dividends, we're going to be going over qualified dividends, BDCs, REITs, some information on if you have a K1 that you have with your investment, which is a very special case. There are not too many out there that require K1, but I'll very quickly go over that as well. If you're new, please hit that subscribe button. I greatly appreciate it, and drop a like down below. Those two things super free and easy to do, and it only takes a second, and it helps me a ton. YouTube algorithm is a tricky one. Help me out. Now, if you already know all the tax things work and everything, there are plenty of other videos on the channel. You should go check those out. Okay, now, without further ado, let's go ahead and take a look here. The dividend tax rates, these are for 2024. Qualified dividend tax rate, you pay 0% if you make $47,025 or below. Married and joint, $94,050 or below. You got your 15%, $47.25 to $518,899 for single, and married is $94,050. That's $94,000. I don't know why I said it like that. To $583,749. Now I don't understand what the heads of the household thing is, so I'm not going to worry about explaining that. If you know about that, let me know down below. And 20% more than $518,900, and for married more than $583,750. That's for your qualified dividends. Now, you might be like, "Oh, how do I know if I get a qualified dividend?" We're going to go over that. We're going to go over qualified dividends, how it works, how to get them. Ordinary dividend tax rates. So this is a bit broader. There's a lot more tiers to this one. 10% for single, $11,600 and below. Married, $23,200 and below. 12% for $11,600 to $47,150, and married, $23,200 to $94,300. Now I'll leave this on screen. You can just kind of take a look at it. I'll highlight these so you're just not listening to me blare off a bunch of numbers, but there's a lot of them. Like, this one doesn't really make sense to me. Why is there a 2% difference here between 22 and 24%? It seems kind of just strange, because this is also a 2% jump, and then it's a 10%, and it's a 10%, and then it's weird. I think it's weird how it's laid out. That was good. But there's those. I'll leave them on screen for a second for you. But yeah, that's the breakdown of ordinary. If your dividends that you get are considered ordinary, these would be your tax rates at which they take their little piece from you. So you might be thinking, so how do I know if my stock's a qualified dividend or not? Well, that's as simple as a quick little old Google away. You can go to dividend.com, type in the stock you want, and just scroll down the payout history, and it will tell you qualified dividend, if it is qualified or not. And if it's not qualified, it'll say non-qualified. Simple as that. You can Google MasterCard dividend and just find this website, dividend.com. Or it can be anything, you know, obviously any stock, any REIT, anything like that, and it will show you here. Okay, so what are qualified dividends? How do I get a qualified dividend? Dividend. A dividend is considered qualified if the shareholder has held a stock for more than 60 days in a 121-day period that begins 60 days before the ex-dividend date. That ex-dividend date is one market day before the dividend's recorded date. Now you might be thinking, what in the blank did this guy just say? What? So their example here, XYZ stock declares a dividend payment on November 20th, sets a record date for a month later on December 19th. Those who bought the stock before December 19th and held it 61 days in the 121-day period that began 60 days before the ex-dividend date pay the capital gains tax rate. So again, this doesn't really explain it all that well, I don't think. So the best way that I can say had it be in this mess here, own a stock 61 days before the ex-dividend date. Pretty sure that's the breakdown of it. Of course, let me know down below if that's off, but from reading this jumbled mess of a mess, that's what I'm getting. Own it for 60 days before the ex-dividend date. Now, I might be completely wrong there. What I'm reading from this. Let me know down below, again, if you've got a better breakdown, if you're able to explain a little bit better. Because this is a shady area. This is like the worst explanation for something in history. Now, REITs and BDCs. How are REITs and BDCs taxed? Most REIT dividends are taxed as ordinary income, which usually is the same rate as wages and are up to 37%. So, the ordinary income, wham bam, that's where you get that at. BDCs are different, are not subjected to entity level tax on distribution income. Returns of capital from BDCs are also not taxed, similar to taking money out of a bank account. However, dividends paid by most corporations are taxed twice, once a corporation and again by the shareholders. That's pretty much all dividends, though. Most of your BDCs will be considered ordinary as well. So that would fall under here. Again, you can do your own research and stuff on that. Make sure, because every stock is different. Every BDC is going to be different. Some of them is going to require K1. I'm going to be honest with you. I don't know much about a K1. That's the one thing I don't really know. I know that if you're investing in some, they're mainly like LPs, MLPs, stuff like that, they're going to give you K1 tax form. And that is something that you can go through TurboTax, and they will assist you in actually filling it out. But it is taxed completely different. It's a whole new animal. I'm not going to sit here and act like I have any idea how K1 tax forms work and stuff like that. I use TurboTax for everything. But, yeah, a lot of your LPs, your MLP, stuff like that will have a K1 tax form attached to it. And again, that's something that's just a simple little Google away. But, yeah, I was just wanting to really go over how dividends are taxed and try my best to explain so you know what kind of dividend that your stocks and holdings are paying out and what to expect from that with your qualified and ordinary tax rates, how to figure it out. Trying to understand qualified dividends. Pretty much, you want a qualified dividend, you like a stock, buy it, hold it for a while, forever. If you're going to hold something forever and it's qualified, you're going to eventually get this. But the best that I understand of this is hold the stock for 60 days before the ex-dividend date. When I read that, I don't. That's what I'm getting from this. Again, let me know down below if you got a better explanation. I'd love to be more informed on this. But yeah, it's a breakdown of everything. I hope you enjoyed that. Again, hit that like and subscribe button for more. And until next time, I hope everyone takes care. See you.